Welcome to Market Pulse USA by AB. This channel is about understanding markets calmly, not chasing noise. Today we're starting a very important discussion, a discussion most people are avoiding. Right now, the US dollar looks strong and silver looks unstable. At first glance, this feels normal, but when two connected assets move differently, something matters. This video is not about predictions. It is about understanding signals, because markets always send signals. The problem is most people listen too late. Silver has been extremely volatile recently. We talked about that in the previous video. That volatility created confusion, and confusion creates bad decisions. At the same time, the US dollar has stayed firm, calm, controlled, confident. This contrast is not random, it is information. When the dollar stays strong during metal volatility, markets are testing something. They are testing confidence, they are testing patience. Many retail traders rush to conclusions here. They assume one asset must be right and the other wrong. But professionals don't think that way. They ask a different question. They ask, which market is telling the truth right now, and which market is exaggerating? Silver reacts faster than most assets. It shows emotion early. The dollar reacts slower. It reflects structural confidence. That difference matters more than price direction. It shows where fear lives. Right now, fear is visible in silver, but confidence still lives in the dollar. This does not mean silver is weak forever. And it does not mean the dollar will stay strong forever. It means we are in a testing phase. And testing phases reveal behavior. Markets are asking, do investors trust stability or do they chase volatility? That question defines January behavior, especially in the first few days. This is why January often feels confusing, because positioning resets quietly. Smart money does not rush on January 2nd. It observes. It watches how assets behave under stress, not how headlines sound. At Market Pulse USA by AB, this is exactly what we focus on. We don't chase moves. We study reactions. Because reactions show intent. Intent shapes direction. If you want daily, calm market understanding, make sure you are subscribed to this channel. In the next part, we will break down why silver reacts emotionally first and why the dollar stays composed longer. That difference explains a lot of January confusion, and it helps you avoid rushing into mistakes. Stay with us. This is where clarity begins. The US dollar often moves quietly. That quiet movement is not accidental. When markets feel uncertain, capital looks for familiarity. The dollar represents stability to institutions, not excitement. That is why it behaves differently than silver. It absorbs fear instead of expressing it. Silver reacts fast because it is emotional capital. The dollar reacts slow because it is structural capital. Structural capital does not rush. It waits for confirmation. Right now, confirmation is incomplete, so the dollar stays controlled. This control is not optimism. It is patience. Many people mistake patience for weakness. Professionals never do. When the dollar holds steady, it signals trust in systems. Trust does not mean growth, it means alignment. Alignment matters more than direction in January, because January sets the tone. After a year-end reset, institutions reevaluate exposure. They don't add risk immediately. They measure reactions first. The dollar helps them do that. It reflects global confidence quietly. This is why dollar strength often appears boring. Boring is not bad. Boring is stable. And stability attracts capital. Silver does the opposite. It tests emotion. That test creates headlines. Headlines create noise. Noise attracts retail attention. But it repels institutions. Institutions prefer clarity. Clarity comes from calm behavior. The dollar's calm behavior tells a story. It says risk is being measured, not embraced. This is not a bullish message. It is a cautious one. Caution dominates early January, every single year. Those who ignore this often enter positions too early. At Market Pulse USA by AB, we focus on avoiding that mistake. We watch how markets behave, not what social media celebrates. Right now, the dollar is not celebrating. It is holding ground. Holding ground is powerful. It means nothing is breaking. Silver's volatility tests confidence. The dollar confirms patience. These two signals together matter. They show disagreement. Disagreement creates opportunity later, not immediately. This is why waiting matters and why rushing fails. If you find this perspective useful, make sure you stay connected to the channel. We break these patterns down daily in simple language. In the next phase, we'll connect dollar behavior to stock market positioning. That connection explains why some rallies fail and others last. Stock markets always listen to currencies, even when traders don't. When the dollar stays firm, stocks become cautious. Caution does not stop markets. It slows them. Slow movement frustrates impatient traders, but it protects institutions. Right now, stocks are not collapsing. They are hesitating. That hesitation matches dollar behavior, not silver behavior. Silver shows stress. Stocks show restraint. This difference is important. It reveals priorities. Institutions care about liquidity first. Returns come later. The dollar represents liquidity confidence. Stocks represent growth confidence. When liquidity confidence leads, Growth confidence pauses. This is why January rallies often stall, not because markets are weak, but because positioning is incomplete. Incomplete positioning creates hesitation. Retail traders misread hesitation. They assume danger. Professionals see assessment. Assessment is not fear. Fear is chaotic. Assessment is structured. Right now, structure is forming, quietly. The stock market reacts carefully to silver volatility. It does not copy it. That tells us something. Stocks are not panicking. They are waiting for confirmation. Just like the dollar, silver is testing stress levels. Stocks are watching the result. This relationship repeats every year, but few notice it. Most people watch price. Professionals watch reaction. Reaction matters more than movement. Movement can lie. Reaction rarely does. It reveals comfort or discomfort. So far, stock reactions show balance, not enthusiasm. Balance suggests discipline. Discipline suggests control. Control does not mean upside is guaranteed. It means downside is respected. This is why breakouts feel difficult right now, because risk is being measured. Measurement takes time. Time frustrates retail. Retail looks for excitement. Institutions look for stability. That difference defines early January behavior every single year. At Market Pulse USA by AB, we track this process daily, not to predict tops or bottoms, but to avoid emotional mistakes. When dollar, stocks, and silver disagree, patience becomes an edge. An edge does not feel exciting. It feels boring. Boring phases protect capital. They prepare opportunity. If this explanation helps you see markets more clearly, make sure you stay connected. We focus on clarity, not hype. This understanding will matter as January progresses, because disagreement never lasts forever. Resolution always follows. Institutions do not chase movement. They chase reliability. The dollar represents reliability in uncertain phases. That is why it attracts attention quietly. Volatility feels attractive to retail traders, but it feels dangerous to institutions. Silver's sharp movement creates opportunity narratives, but narratives do not equal safety. Safety matters more than opportunity early in January, because mistakes are expensive. Institutions prefer assets that behave predictably. The dollar offers that behavior. Predictability reduces execution risk. Reduced risk allows patience. Silver does the opposite. It exaggerates emotion. Emotion clouds. Judgment. Judgment is critical at the start of the year. This is why institutional capital avoids rushing into metals. They let metals test themselves first. Testing reveals who is emotional and who is disciplined. The dollar does not need to prove discipline. It represents structure by default. That structure becomes valuable during resets. Resets happen every January. After resets, capital realigns slowly. Slow alignment prevents regret. Regret damages long-term positioning. Institutions avoid regret. Retail traders often rush to avoid missing out. That rush creates exposure. Exposure without clarity is dangerous. Danger increases stress. Stress leads to forced decisions. Forced decisions often fail. Institutions remove stress by waiting. Waiting is strategic. Silver's volatility adds stress. The dollar reduces it. Now, this contrast explains current behavior. It is not random. Institutions also watch how markets respond to calm assets. Calm assets show confidence. Confidence does not require excitement. It requires consistency. The dollar's consistency matters right now. It anchors expectations. Anchors stabilize portfolios. Stability matters before growth. Stocks also respond to this anchor. They slow down. Slowing down is not bearish. It is cautious. Caution defines early January, every single year. Retail traders expect immediate trends. Institutions expect testing. Testing filters weak positioning. Filtering strengthens structure. Silver is part of that filter. It exposes impatience. The dollar rewards patience. Patience is institutional language. This is why institutions lean toward the dollar first, not because they love it, but because it behaves. Behavior builds trust. At Market Pulse USA by AB, we focus on explaining this behavior clearly, so you don't confuse calm with weakness or volatility with opportunity. Understanding this difference matters. It protects capital. As January continues, this relationship will evolve, and when it does, those who waited will be ready. Retail traders often feel uncomfortable in calm markets. Calm feels unproductive to them. They prefer movement. Movement feels like opportunity. But opportunity without clarity is dangerous. Danger hides behind excitement. When silver moves sharply, retail attention shifts immediately. Social media fills with opinions. Opinions feel like information, but opinions do not protect capital. Behavior does. Retail traders often assume volatility equals direction. That assumption creates early entries. Early entries feel smart until they are tested. Testing removes confidence quickly. Confidence without structure is fragile. This is where many traders exit too early or enter too late. They react to noise instead of signals. Noise is loud. Signals are quiet. Quiet requires patience. Retail also struggles with waiting. Waiting feels like missing out, but missing out is safer than rushing in. Safety matters early. Another mistake is overconfidence. Small wins feel validating. Validation does not equal confirmation. Confirmation takes time. Retail traders often ignore context. They isolate one asset. They focus only on silver or only on stocks. Professionals connect assets. Connections reveal intent. When dollar strength and silver volatility disagree, context becomes critical. Retail ignores this disagreement. Professionals study it. Another issue is emotional storytelling. Stories simplify complexity, but markets are complex. Simplification creates false comfort. Retail traders also anchor to recent moves. Anchoring limits flexibility. Markets move forward, not backward. This anchoring causes hesitation. Hesitation causes poor timing. Another misreading is impatience with consolidation. Sideways movement feels pointless, but sideways movement builds clarity. Clarity protects positioning. Retail often abandons positions during boredom. Professionals accumulate information. Information improves decisions. Decisions shape outcomes. Retail traders also underestimate time. They want answers now. Markets deliver answers slowly, slowly by design. This design filters emotion. Emotion is the enemy. Another mistake is reacting to every headline. Headlines exaggerate urgency. Urgency forces action. Forced action increases error. Retail also compares performance constantly. Comparison creates pressure. Pressure destroys discipline. Discipline creates consistency. Consistency beats excitement over time. Time rewards patience. Retail traders often expect January to reward boldness. January rewards restraint. Restraint protects capital. Protection creates longevity. At Market Pulse USA by AB, we focus on helping you avoid these traps. We explain markets calmly, so you don't trade emotionally. Because emotional decisions feel right until they fail. This phase is not about making money fast. It is about not losing it unnecessarily. Those who survive January well often perform better later. Understanding this phase gives you an edge that doesn't feel exciting, but it feels stable, and stability matters. As markets move forward, this behavior will become clearer. Those who waited will recognize it. Those who rushed will chase again. Smart money does not argue with the market. It listens. Listening starts with observation, not action. While retail debates direction, institutions review behavior. They study how assets react under pressure. Reaction reveals intent. The dollar's calm behavior attracts attention. Calm signals confidence. Silver's volatility attracts emotion. Emotion signals uncertainty. Institutions prefer confidence over excitement. Excitement fades quickly. This preference shapes positioning. Positioning is not rushed. Smart money scales exposure slowly. Slow scaling reduces regret. They start with small commitments. Small commitments allow flexibility. Flexibility matters when signals are mixed. Mixed signals dominate early January. Institutions also diversify timing. They do not enter all at once. Staggered entries reduce risk. Risk control is priority. Another behavior is patience with confirmation. Confirmation must survive testing. Testing takes time. Time filters noise. Smart money also limits commentary. Less talking, more observing. Observation improves clarity. Clarity improves execution. They also track cross-asset behavior. Dollar, stocks, and metals are connected. Connections reveal alignment. Alignment guides exposure. When alignment is missing, institutions wait. Waiting is not inactivity. It is preparation. Smart money also manages expectations. They expect setbacks. Setbacks do not surprise them. Surprise creates mistakes. They plan for volatility. Planning reduces emotion. Another discipline is respecting failed moves. Failed breakouts are information. Information is valuable. Ignoring it is costly. Institutions also watch liquidity closely. Liquidity availability matters. Reliable liquidity invites participation. Unreliable liquidity repels it. They prefer environments where exits are controlled. Control protects capital. Smart money also adjusts position duration. They hold shorter during uncertainty. Shorter duration increases agility. Agility matters now. As clarity improves, duration extends naturally. This extension is gradual. Gradual movement builds trust. Institutions also avoid forcing narratives. Narratives distract. They focus on evidence. Evidence comes from behavior. Retail seeks certainty. Smart money accepts probability. Probability guides positioning. Certainty does not exist. Another key behavior is emotional neutrality. No celebration, no panic. Neutrality preserves discipline. Discipline preserves capital. This is why smart money often appears late. Late, but prepared. Prepared beats early, every time. At Market Pulse USA by AB, we focus on explaining these behaviors clearly, so you don't confuse patience with fear or calm with indecision. Understanding this positioning matters. It explains why moves feel delayed, but delays are part of structure. Structure precedes direction. As January progresses, this positioning will reveal itself. Those who waited will recognize it. Those who rushed will adjust again. Market conflicts do not last forever. They resolve through behavior. When two assets disagree, time becomes the judge. The dollar and silver are disagreeing right now. That disagreement is intentional. It forces participants to reveal patience, or lack of it. Resolution does not arrive suddenly. It arrives quietly. The first sign is reduced volatility. Moves become less emotional. Silver stops reacting violently to headlines. Reactions become measured. Measured reactions signal stabilization. Stabilization invites clarity. At the same time, the dollar stops gaining urgency. It holds instead of pushing. Holding is important. It shows balance. Balance suggests confidence is spreading, not excitement. Another sign of resolution is correlation improvement. Assets begin moving more coherently. Disagreement fades gradually. Alignment replaces confusion. This alignment does not mean everything rallies. It means signals stop conflicting. When signals stop conflicting, decision-making improves. Institutions wait for this moment. They do not force it. Retail traders often miss this transition. They expect fireworks, but markets rarely reward drama. They reward patience. Another resolution sign is time spent consolidating. Price ranges tighten. Tighter ranges absorb remaining uncertainty. Absorption prepares direction. Volume behavior also changes. Extreme spikes disappear. Steady participation replaces urgency. Urgency fades first. Silver begins respecting levels consistently. Levels stop breaking impulsively. This respect builds confidence. Confidence attracts capital. The dollar continues acting as an anchor. It stabilizes expectations. Anchors are important during transitions. They prevent emotional swings. Stocks respond positively to this alignment, not aggressively, but steadily. Steady movement reflects maturity. Maturity supports sustainability. Another resolution clue is reduced commentary. Market narratives quiet down. Silence increases focus. Focus improves execution. Institutions also begin extending duration. Positions are held longer. Longer duration signals trust. Trust supports trends. Retail traders often re-enter late. Late entry increases risk. Professionals enter earlier during calm phases. Calm phases feel boring, but boredom is protective. Protection matters before opportunity. Opportunity comes later. Another sign is improved overnight stability. Futures gaps shrink. Smaller gaps show reduced fear. Fear always exaggerates movement. As fear fades, clarity increases. Clarity improves positioning. This resolution phase does not guarantee upside. It guarantees understanding. Understanding is valuable. It prevents emotional mistakes. At Market Pulse USA by AB, we focus on recognizing resolution early. Not to rush, but to prepare. Preparation separates professionals from amateurs. Amateurs chase outcomes. Professionals prepare for them. Preparation wins over time. As January continues, this dollar and silver relationship will evolve. When it does, those who waited will see it clearly. Those who rushed will adjust again. Adjustment costs time. Time is the most valuable asset. Protect it. Markets never speak in headlines. They speak in behavior. The conflict between the dollar and silver was not a signal to act fast. It was a signal to slow down. Silver showed emotion early. The dollar showed restraint. That contrast mattered more than direction. It revealed mindset. Mindset always comes before movement. Those who understand this survive volatility. This phase was not about winning trades. It was about avoiding bad decisions. Volatility tested patience. Patience filtered participants. Some rushed, some waited. Waiting did not feel exciting, but it preserved clarity. Clarity protects capital. Capital protection creates opportunity later. The dollar acted as an anchor throughout this phase. Anchors stabilize expectations. Silver acted as a stress indicator. Stress reveals emotion. Emotion never leads markets long term. Structure does. Structure forms quietly, without celebration. That is why many missed it. Noise distracted them. Those who watched behavior stayed calm. Calm allowed learning. Learning improves timing. Timing matters more than prediction. January is always about adjustment, not acceleration. Those who accept this adjust well. Those who fight it struggle. This conflict will not define the entire year, but it sets tone. Tone influences confidence. Confidence influences behavior. Behavior creates outcomes. Outcomes reward discipline. The dollar versus silver story was never about choosing sides. It was about understanding disagreement. Disagreement forces markets to reveal truth. Truth is rarely dramatic. It is subtle, and it is quiet. Professionals listen for that quiet. Retail waits for excitement. Excitement fades. Understanding lasts. At Market Pulse USA by AB, this is exactly why we do what we do. We study markets daily, not to predict tomorrow, but to understand today. Understanding builds resilience. Resilience allows consistency. Consistency builds confidence. If this video helped you slow down your thinking, then it did its job. If it helped you avoid rushing into noise, then it added value. This channel exists for that purpose. Clarity over chaos. If you want daily, calm market understanding, make sure you are subscribed to Market Pulse USA by AB. Like the video if it helped. Share it if someone else needs clarity. And if you have questions, drop them in the comments. We read them and we respond. In the next video, we will connect this dollar and silver behavior to what stocks usually do next. That connection surprises many people, but it follows a pattern. We'll break that pattern down simply so you are prepared. Stay patient, stay disciplined, and stay aligned with reality.